So, based on the description for a revenue growth manager at Carlsberg Canada Incorporated, the role is heavily focused on revenue growth management and value management, with responsibility for driving profitable growth through pricing, promotion, assortment optimization, and trade terms. Below are the key KPIs metrics this role will be accountable for. Key performance indicator for revenue growth manager at Carlsberg Canada. Pricing and profitability metrics. Gross margin percent by brand and product. Ensuing pricing strategies protect profitability. Price elasticity analysis. Measuring how price changes impact volume and revenue. Competitive price checking. Monitoring competitor pricing shift. Motion cost and NABET. Motion coolers. Motion coolers. Profit and loss impact of price changes. Assessing how adjustments affect net revenue and profit. Profit and promotional effectiveness. Promotional lift percentage. Volume over revenue. Increase during promotions versus baseline. Promotion ROI, profitability of promotion, incremental profit versus cost. Golden protection rules compliance, ensuring promotions aligns with category strategies. Assortment optimization, SKU rationalization, percentage of low performing SKUs phased out. New product launch performance. Revenue contribution of new products, limited additions, market shares by brand or pack. Tracking Carlsberg versus competitors in key segments such as cider and premium lager. Revenue growth market performance. Led revenue growth, overall sales growth across provinces and channels. Channel specific revenue performance in on-trade bar or restaurant versus off-trade retail. Provincial market shares. Carlsberg's percentage of beer or cider sales in key markets such as Ontario and Quebec. Trade terms and customer performance. Customer profitability, revenue contribution, margin by key accounts. LCBO, Walmart, Canada. Trade spend efficiency, measuring ROI on discounts or trade promotions. Sell-in stories, success rate, adoption of pricing or assortment proposal by retailers. Data and forecasting accuracy, promotion forecast accuracy, variance between predicted versus actual promo results. Price pack architecture, compliance, adherence to optimal price pack strategies. How these KPIs align with the job description. Lead the annual pricing process with impact on the gross margin percentage and P&L impact. Optimize promotions, promotional lift, promotion ROI. Define assortment strategies, SKU rationalization, new products performance. Check competitor pricing, competitive pricing tracking. Customer sell-in stories, trade spend efficiency, customer profitability. Inventory benchmark, Canada beer market, Target gross margin 40% to 50% for premium brands. Promotion lift expectation 15% to 30% volume increase for effective campaigns. Market share goal. Grow Carlsberg Canada's 4 to 5% shares in premium or cider segment. So you will be doing this role is designed to support Carlsberg Canada commercial teams across all provincials and channels in driving profitable growth while building foundational revenue management capabilities, tools, and process. As part of your responsibility, you will act as a pioneer and change catalyst, being a central figure in the organization when it comes to establishing value management in Canada. Working closely with senior management, define and implement the 3-year value management strategies across all provinces, customers, portfolio, and channels, in close collaboration with senior management and cross-functional teams, based on category and portfolio strategies. Lead the development of commercial plan regarding assortment, pricing, promotion, while driving revenue management discussions and initiatives. Lead the annual pricing process and are responsible for commercial price pack strategies in alignment with Carlsberg Canada category and portfolio strategies. Check and evaluate price changes in the market, including key competitors at the category, province, channel, and pack type level, translating findings into optimized pricing strategies, including P&L impact assessment. Analyze market data and trends to identify new profit pools and define the optimal national assortment within the annual brand pack price channel planning process. Develop category golden promotion rules in coordination with the commercial leadership team and implement customer and channel specific promotion optimization. Manage Carlsberg Canada's promotional plan and forecast, analyzing promotion volume and profitability lift versus baseline, optimizing them for profitable channels and customer development. Prepare and present report and recommendation on pricing, promotion, and assortment for commercial management. Translate commercial trends and insights into actionable steps for revenue creating assortment and pricing strategies. Presenting recommendation to management. Engage with relevant stakeholder daily. Building trust as an advisor within the company on pricing, assortment, and commercial insights. Take the lead in developing tools and reports to support capability embedment. Embedment in the German phrase refers to the state of being firmly fixed and enclosed with a surrounding nest. Capability embedment. In the phenomenon mechanical engineering, in which the surface between mechanical members of a node joined and back. The hardware which is running. Embedment. existing or firmly attached within something or under a surface. Detailed example. This gives me a detailed example for act as a pioneer and change catalyst, being a central figure in the organization when it comes to establishing value management in Canada, working closely with senior management. Detailed example. How the revenue growth manager acted as a pioneer and change catalyst for the value management at Carlsberg Canada. Scenario: launching a value management initiative for Carlsberg. Kronenbourg 6064 Bro. Kronenbourg. Kronenbourg 6064 Blanc. Objective: improve profitability of Kronenbourg 6064 Blanc, a premium white beer. White. Wheat. Wheat beer, a premium wheat beer, by optimizing price, promotion, and assortment in Canada, while establishing Carlsberg first structure revenue growth management framework. Diagnose the current challenges, problem identification. Kronenbourg Blanc has high consumer demands but low margins due to excessive discount in retail, frequent $2 off of promotions at LCBO, inconsistent pricing across provinces, such as $12.99 in Ontario and $11.50 in Quebec. Poor trade terms with restaurants, such as free cake placements, eating into profit. let me clarify the mechanics of the retail promotion in the beer alcohol industry. How excessive discounting actually impacts Carlsberg Canada's margin, even though LCBO, the retailer, is the one physically offering the $2 off promotion to consumers. How promotion works in alcohol distribution, the hidden margin impact. When LCBO wants $2 off Kronenbourg from promotion, Carlsberg Canada doesn't watch from the sidelines. It financially participates in the discount. Here's why. Trade spend, promotional allowance. The reality, a retailer like LCBO rarely absorb the full cost of promotion themselves. Instead, they require supplier Carlsberg Canada to fund a portion of or all of the discount through off-invoice allowance, temporary price reductions to LCBO, such as Carlsberg sold at $10 per case instead of $12 during promotional periods. Bill backs. LCBO charge Carlsberg back for $2 discounts after the fact. Continue. Thus. Bill backs. Bill backs, also called chargebacks or promotional deduction, are post-sales fee that retailers, LCBO, charge suppliers to cover the cost of discount, promotions, or other trade expense. Unlike upfront price reduction of invoice allowance, bill backs are deducted after the retailers has already paid the supplier, creating unpredictable margin erosion. Step-by-step example: Kronenbourg Blanc promotion. Initial sales: Carlsberg sells 1,000 cases of Kronenbourg to LCBO at $12 per case. That would be $12,000 revenue. Promotional ones. LCBO offers a $2 per case promo to consumers. Bill back calculation. LCBO sells 1,000 cases during the promo and charge Carlsberg $2 case retroactively. Retroactively, extending the scope or effect to a prior time or to the condition that exists or originated in the past. Total bill back 1,000 times 2 equals to $2,000 owed to LCBO. Net revenue to Carlsberg, that will be original revenue, $12,000 minus paid bill back $2,000, final revenue, same as Carlsberg have given an upfront discount. Why build-back are problematic? Why build-back are problematic for suppliers? Margin surprise. Carlsberg initially sold 12,000 revenue, but the 2,000 deduction hit later, distorting financial tracking. Cash flow strain. LCBO may deduct build-back from future payments, withhold 2,000 from the next invoice. To make top draw tight. Climber strains their root until it's broke and draw tight. You use one's effort to or strength as much as possible to injure a muscle by stretching too hard. He strained his neck muscle on that last drum. Retailer leverage. Large chains like LCBO can unilaterally impose build-backs if suppliers don't agree to promotion. Undertaken or done by or on behalf of one side, partly or group only, not mutual, unilateral. Real world beer industry build-back. Types of build-back. Promotional discount, $2 off campaigns. Shelf placement fees. Paying for end cap displays, penalty for late deliveries or incorrect orders. Carlsberg defense, the revenue growth manager negotiates payback caps, such as maximum $1 per case, or ties them to revenue to volume threshold. Only pays if sales lift increase by 20%. Build-backs versus off-invoice allowance. Timing. Build-backs deduct after sales. Off-invoice allowance. Discounts applied upfront. Predictability, low surprise cost. For off-invoice, this is high. This is round reduction. Cash flow impact for build-backs is negative, delayed deduction. For the off-invoice allowance, it is neutral, immediately lower revenue. Control, retailer driven. For the off-invoice allowance, supplier driven. Key takeaway, build-backs are hidden cost of doing business with powerful retailers. For Carlsberg Canada's revenue growth manager, minimizing them is critical to protecting margins. Hence, the push for smarter promotions, such as bundling over strict discount. Want to see how this pay out in P&L? Here's a simplified comparison. Carlsberg Canada P&L with versus without build-backs. Scenario: no promotion, $12,000. COGS, $6 per case. That would be 6,000. Gross profit, there will be 6,000. Margin there is 15%. with promotion with payback with bill back, there will be only 40%. Solution replace bill back heavy promotes with long discount tactics such as loyalty program. So here's a step-by-step breakdown of how Carlsberg Canada would account for a bill promotion in its financial record from launch to settlement using the Carlsberg. Carlsberg belonged to LCBO as $12 case. So initial sale to LCBO promotion transaction, Carlsberg shipped 10,000 of Carlsberg Blanc to LCBO at $12 per case. Accounting entry, there will be debit account receivable. LCBO 12,000 assets increased. Amount LCBO owned Carlsberg. Credit revenue. Credit revenue, there will be $12,000. Revenue recognized at full wholesale price. COGS entry 6,000 are recorded separately but omit here for simplicity. Promotion period, LCBO won $2 off discount. Activity, LCBO sells 1,000 cases to consumers at a discount price. Carlsberg is contractually obligated to reimburse LCBO $2 per case, 2,000 total via bill back. accounting consideration. Carlsberg cannot record the bill back because LCBO hasn't formally claimed it, usually done at month end. To comply with accrual accounting, Carlsberg estimates the bill back liability. So that will be accounting adjusting entry month end, debit promotional expense or reduction of revenue 2000. Expense record to match revenue. With costs at the same time. Credit bill back liability, accrual expenses. So LCBO issue bill back deduction. Transaction. LCBO deduct 2000 from its next payment to Carlsberg. Debit bill back liability, accrual expenses 2000. Liability is reduced, obligation settled. Credit account receivable 2000. So assets decrease. LCBO paid 10,000 instead of 12,000 net result. Carlsberg cash receipt 10,000. Revenue recognized 10,000 net. Visual summary. Carlsberg accounting flow. Key principle applies. Key principle applied. Revenue recognition. Revenue is record net of expected bill backs. 10,000 net versus 12,000 gross. Matching principle. Bill back expense is accrued at the same period as the relevant revenue, as the related revenue. Liability management. Bill back liability appears on the balance sheet until settled. Impact on financial statement. Income statement 10,000. Lack of bill back. Revenue. Okay. Gross profit 4,000. Balance sheet. After deduction, account receivable 10,000. Bill back liabilities $0. Why this matters for Carlsberg revenue growth measure? Margin checking. Bill backs must be forecast accurately to avoid profit surprise. Negotiation leverage. Understanding this flow help push back on excessive retailer demands. Boutique companies often use provision accounts, such as allowance for trade deductors, to check estimated bill backs before formal claims. Here's a detailed actionables. Okay. So, how promotion works in our alcohol distribution, the hidden margin impact. When LCBO runs a $2 of Carlsberg Blanc promotion, Carlsberg Canada doesn't just watch from the sidelines. It financially participates in the discounts. Here's why. Chase Bank, the reality, Chase Bank promotional and allowance. The reality, the retailers like LCBO rarely absorb the full cost of promotion themselves. Instead, they require suppliers, Carlsberg Canada, to fund a portion or all of the discounts through off-invoice allowance of paybacks. Off-invoice allowance are temporary price reduction to LCBO, such as Carlsberg sells $10 per case instead of $12 per case during promotion periods. Billbacks. LCBO charge Carlsberg back for $2 case per case discount after the fact. Example, normal wholesale price. Carlsberg sells Kronenbourg to LCBO at $12 per case. During promotion, LCBO demands a $2 per case discount. So Carlsberg let revenue drop to $10 per case. LCBO then pass the $2 saving to consumers to drive sales. Why this hurt Carlsberg margin? Gross margin erosion. Normal margin. If the COGS is $6 per case, the gross margin will be $12 minus $6 divided by $12, there will be 50%. Promo margin, with the $2 allowance, margin would decrease to 40%. So, volume doesn't always compensate. If the promotion don't drive enough incremental volume, only 50% lift versus the need 25% to break even. Carlsberg lose money. This vicious cycle. Vicious cycle. Vicious cycle. This the vicious cycle of discounting. Retailer expectation. LCBO starts expecting promotion as standard, refusing to list Kronenbourg without them. Brand devaluation. Consumer wait for discount, refusing to pay full price. Why buy at $13.99 when it would be $11.99 next week? Competitive pressure. If AB InBev, Whole Garden also discount, Carlsberg must match or lose shelf space. How the revenue growth manager fix this? The manager role is to optimize promotion so they are profitable. In earlier example, they first of all limit frequency, reduce promotion from 6x to 2x to reset customer expectation. Secondly, shift tactics, replace strict discount with bundles, free gasware that protects wholesale price. Negotiate with LCBO, agrees to fund only high impact promotions. For example, holiday weekends with strict volume guarantees. Even though LCBO wants the promotion, Carlsberg Canada margins are directly impacted because it funds the discount. The revenue growth manager's job is to ensure every dollar spent on trade promotion generates measurable return. Six per year means 6 times per year, roughly every 2 months. In the context of Carlsberg Canada promotion, before revenue growth manager intervention, Kronenbourg Blanc was a discount 6 times annually, monthly or bi-monthly promotion at LCBO, training consumer to wait discounts instead of buying at full price. After intervention, promotions are reduced to 2x per year, only during peak season like Christmas and summer, making discount more strategic and profitable. Why frequency matters? Consumer psychology. Frequent discounts devalue the brand. Why pay $13.99 when it will be $11.99 next month? Where promotion creates urgency. Limited time deal. Margin protection. Fewer promotions, less reliance on bill backs. Higher net revenue per case. Retailer leverage. LCBO may demand fewer fund promotions if they high impact, 2x per year, with 30% sales lift versus 6 times per year with 10% lift. Exclusive deal. Okay, more premium feeling. How the revenue growth manager implements this data analytics. Reviews historical promo ROI. 6 times per year drove volume but erode margin. Negotiation works with LCBO to replace routine discounts with long price tactics. In-store tasting, monitoring, track 2 times per year, promotes, maintain volume and improving margin. Result: gross margin improves from 45% to 55% from reduced bill back. Brand equity, consumer perceive Kronenbourg as one full price. So case study replacing strict discounts with bundles to protect margin. Brand Carlsberg Blanc, retailer LCBO Ontario. Increase promotion profitability by shifting $2 off discount to bundles offer, such as free gasware. Current problem: big discount kills margin. Promo mechanics: all tactics, $2 off per case at LCBO. Wholesale price $12 per case. Carlsberg sell to LCBO. Bill back. Carlsberg funds the full $2 and net revenue drops to $10 per case. COGS $6 per case. Gross margin that would be 40%. Consumer behavior: shoppers wait for discounts. 70% of Carlsberg volume comes from promotion. New tactics: bundle with free gasware. Promo mechanics: bundle offer. Buy 2 cases of Carlsberg Blanc, get a free branded glasses. $5 per value. Cost structures: wholesale price remains $12. $12 per case. No bill back. Gasware cost to Carlsberg, that would be $1.5 unit bulk order, and total cost for the bundle $150 plus $12 per case. And for the consumer perceived $5 value for the gasware, but Carlsberg cost is only $150. Assumption: LCBO sells 2 case bundle during promotion. Promotion drive 30% incremental volume versus 15% with $2 off. Comparison: wholesale value, pricing $10 per case. Wholesale revenue for gasware bundle $12 per case. Incremental cost no for $2 off discount. $150 for the glass. Gross margin that would be $40. 40%. For the gross margin for the gasware bundle, that will be 37.5%. Volume lift, assume there will be 15%, $2 off discount. But for gasware bundle, that will be 30%. So cost per 1,000. Cost per 100 cases, that will be $400 for the $2 off discount. $450 for the gasware bundle. Key insight: bundles margin is slightly lower per case, 37.5 versus 40%, but higher volume lift, plus 30% versus 15%, and full wholesale price delivered, 12.5% more profit. Why bundles win? Protect wholesale price, no bill back. LCBO paid full price, full $12 per price. Consumer perception: free gasware feels premium versus discounts. I'm getting something extra. LCBO benefits: bundles can be featured in flyers as a gift with purchase, driving foot traffic. Implementation steps for Carlsberg Canada. First, cost appreciation. Source gasware lower than $150 per unit. Bulk order from Chinese supplier. Retailer pitch: convince LCBO to replace discounts with bundles by highlighting high basket size, 2 case purchase, better shelf feasibility. Promote end caps and performing tracking measures, sell-through rate, units moved, post post promote baseline sales to assess brands equity impact. Long-term impact, brand equity less reliance on discount. Kronenbourg seen as worth full price. Retailer relationship. LCBO gets unique offer. Fewer margin rules. Profit growth. Even a 5% in full price sales. Even a 5% in full price sales post promo boost margins. Boost margins. Okay. Okay, that's it. See you next time.